Howdy, everybody. Welcome to Liberty Call. Today is Tuesday, March 5th, 2024. Hope everybody's having a fantastical day out there. It's a little gloomy here in Colorado. It was sunny this morning, but the clouds have moved in. I think we're going to get a little precipitation tomorrow. So, yay, and it's supposed to get cool. So, got to put jackets on again. Anyways, like I said, hope you're having a good day out there. If you can see my boy Jake back here, he is super excited for today's news. It is pins and needles. Market's not in a good mood today. Everybody's kind of waiting to see what Chairman Powell's going to say tomorrow during his congressional testimony. So I don't know why that made the markets drop over 1% here domestically, but I guess everyone's just worried where things are going. So, all right. Well, let's before we jump into it, if you could do me a favor, if you could give me some thumbs up, like, share, subscribes, follows, and press that notification bell, because you don't want to miss out on all this smart stuff I'm about to talk about. I mean, not everything is smart. I mean, maybe one or two stories this week. Anyways, all right, let's get into the numbers for today. Dow Jones was down 1.04%, 404 points, closed at 38,585. S&P 500 down 1.02%, closed at 5078. NASDAQ down 1.65% today, closed at 15,939. The VIX was up 7.26%. It's at 1447 right now. Canada flat, down 0.02. Brazil down 0.26. Mexico flat, up 0.03. In Europe, Germany was down 0.03. The UK up 0.08. France down 0.3. In the Netherlands, they were down 0.63%. Italy. Spain was up 0.47%. Italy up 0.71%. Switzerland down 0.12%. And Portugal up 0.19%. Russian exchanges, again, they were both green. The MOEX up 0.12%. The RTSI up 0.95%. And the Asian markets, the Nikkei was up 0.07%. Australia down 0.15%. New Zealand flat at 0. In China, the Shanghai was up 0.28%. The Shenzhen Component down 0.23%. China A50 up 1.31%. DJ Shanghai up 0.23%. Hang Seng down 2.61%. And the Taiwan weighted was closed again. All right, so kind of a mixed day. Again, I'm not sure what the TV says it's because everyone's worried about what Chairman Powell's going to say tomorrow. I don't know if that's really the reason, but we shall see. Okay, let's get to the market recap for today. U.S. stocks fall as big tech stumbles ahead of Powell's testimony. On Tuesday, U.S. stocks experienced a downturn as investors tempered their bullish stance on major tech companies ahead of Federal Reserve Chairman Jerome Powell's testimony before Congress. Powell's remarks, anticipated over 2 days, are expected to maintain a hawkish stance, emphasizing the Fed's need for more evidence that inflation is nearing its 2%, the target of 2%. Despite some expectations for rate cuts by June, several Fed officials have cautioned against premature actions, citing concerns about persistent inflationary pressures and the resilience of the U.S. economy. Attention also turns to the key non-farm payrolls data for February as a gauge of economic health. Tech giants such as Tesla, Apple, and AMD contributed to the market decline. Tesla shares dropped 4% following reports of decreased shipments of its China-made cars amid a price war in the EV market. Additionally, AMD faced pressures after reports of U.S. government obstacles hindering its AI chip sales to China. Apple's shares fell over 2% amidst reports of a significant decline in iPhone sales in China attributed to heightened competition from local firms. However, optimism remains for Apple's ability to meet sales expectations, supported by its robust services business. In other sectors, Target saw a notable increase of over 12% after reporting better than expected earnings for the fourth quarter and unveiling plans for a new paid membership program. Conversely, Stitch Fix shares plummeted more than 19% as the company lowered its full-year revenue outlook due to a decline in active users. Meanwhile, Bitcoin experienced a sharp reversal, dropping over 6% after reaching a new all-time high, prompting profit-taking among investors. This decline impacted crypto-related stocks like Coinbase, Marathon Digital Holdings, and MicroStrategy, the later announcing plans to sell $600 million in convertible senior notes. All right, so kind of a meh day in the markets. Even Bitcoin's rally really stalled. Let me bring up the chart and we can take a look at it. There's BTC, and put that on the screen there for you. Let's go to the daily, and yeah, we can see how it is just since really February, just right up. I mean, up like 65% 5%. Again, Bitcoin is very volatile. This is not an endorsement of it. Buy it at your own risk. But it's definitely a big jump there. And then, a nice fall today. All right. Let's get that off the screen there. All righty. Next up, I got a report from First Trust for the February ISM non-manufacturing index. We'll just go ahead and read the text as it stands and see what they had to say. Despite weakening economic data elsewhere, the U.S. services sector remains resilient for now. Services activity continued expanding in February, with 14 out of 18 major industries reporting growth, although not as fast as in January. Looking at the details, the indexes for business activity and new orders, the two forward-looking pieces of the report, both rose in February and sit at 5- and 6-month highs, respectively. The pullback in the headline index was due to faster deliveries in February, signaled by a sub-50 reading in the Supplier Deliveries Index. Let's see here, as well as the employment index falling back into contraction territory. Hiring activity in the services sector looks to be cooling in recent months, as the index sits in contraction territory for the second time in 3 months, while more industries reported a decline in employment in February versus an increase. On the inflation front, prices continued to rise in the services sector, now for the 81st month in a row. Although the index is well below the backbreaking pace of 2021 and 2022, make no mistake, inflation remains a problem in the services sector. 13 industries reporting paying higher prices during the month of February. When you contrast the details of today's report with the February ISM report on the manufacturing sector, where the activity has contracted 16 consecutive months and the majority of industries reported contraction or no growth, there has clearly been a divergence in activity. The services sector was a lifeline for the U.S. economy in 2023. What do we expect this year? An eventual weakening as the economic morphine from COVID wears off, and the impact of recent reductions in the M2 measure of the money supply make their way through the economy. We continue to believe a recession is on the way and think investors should stay cautious and as we move through these unprecedented times. In other recent news, Americans bought cars and light trucks at a 15.8 million annual rate in February, up 6% from January and 6.3% higher than a year ago. All right, so again, it's kind of a good news, bad news situation. The non-manufacturing index still remains strong, but the manufacturing index is not. So, again, there is that divergence between the two lines of business, I guess, be the way to say it. All right, up next, I saw this article over the weekend, and it was on the Google homepage. I figure if I'm seeing it, you're seeing it, so might as well talk about it. This comes from Fortune magazine. The title is Hotshot Wharton Professor Sees 34 trillion debt triggering a 2025 meltdown as mortgage rates spike above 7%. It could derail the next administration. Well, I'm not in favor of any administration. I'd like to see the government burned to the ground, but that's just my own personal view. All right. Professor Joe Gomes from the Wharton Business School has been sounding the alarm on America's rapidly growing public debt, a warning that many have overlooked. I don't know who's overlooking it. It's certainly not me. Gomes, recognized for his academic achievements and positions at the university, is concerned about the potential consequences of the staggering 34 trillion national debt, predicting it could disrupt global financial markets as early as next year if not addressed. He points out the possibility of interest rates skyrocketing to 7% or higher if Washington continues to ignore the issue, drawing parallels to the UK's mortgage crisis during Prime Minister Liz Truss's tenure. Gomes emphasizes that the debt problem is bipartisan, originating from both the Trump and Biden administrations, and urges a serious reevaluation of fiscal policies. I agree. I love to body slam the left as much as possible, since most of their ideas are just crazy in my opinion. But half the inflation we're dealing with right now is on Trump. He signed, one of those huge stimulus bills in, I think it was June or July of 2020. Certainly didn't help the situation, and really was the springboard for more stimulus and more government spending after he left office in January of the following year. All right. Gomes warns that failure to address the debt issue could lead to a financial crisis by 2025 with significant implications for the economy and consumers. He highlights warning signs such as diminishing foreign investment in U.S. debt and the potential for a market backlash against excessive spending. The consequences of a debt crisis would not be limited to the U.S., affecting global markets and economies. Gomes suggests that while solutions like economic growth or spending cuts could mitigate the crisis, the reality remains daunting with no easy way to avoid its impact on individuals worldwide. I agree. I think we're headed towards a big mess. Again, I could be completely wrong, and the Fed could, land the Spruce Goose into, what was it, San Francisco Bay? Is that where they landed it? Just a nice smooth landing. And I have very little doubts. I think it's going to be more like crashing on the flight deck when the gear won't go down and they have to catch it in the net. So, never got to see that live, which also I didn't spend a whole lot of time out on the boat. So would have been something I would have taken part in, but anyways. All right, last up, got one more article here from Zero Hedge. It's titled Bubbly Parts of the Market Might Get Bubblier Still. And this comes from Simon White of Bloomberg. Bloomberg. All right. In Simon White's analysis, the tech sector remains a dominant force in driving returns within the U.S. stock market. While multiples are elevated, they have not yet reached the extreme levels seen prior to the dot-com bubble burst. White references Zeke Faux's book, Numbers Go Up, which discusses the crypto market's exuberance, suggesting a similar trend may be emerging in stocks, with investors displaying increasing FOMO, fear of missing out, driven behavior. Tech sector valuations, particularly PE multiples, are currently significant contributors to overall market returns, reminiscent of the late 1990s. However, White notes that while tech multiples are high, they are not surpassing levels observed during the dot-com era. Similarly, equity risk premium are elevated across most sectors, indicating a broader overvaluation compared to historical norms. Despite these warning signs, White suggests that further market exuberance could occur before a significant correction takes place. He highlights the attractiveness of portfolio hedges due to low volatility, with options providing cost-effective protection against potential downturns. White concludes by cautioning investors about the treacherous nature of bull markets, drawing parallels between current market conditions and the dot-com period. While acknowledging the possibility of continued upward momentum, he advises investors to remain vigilant and aware of emerging risks associated with overvaluation and speculative behavior. Again, be careful. The markets and the economy are very frothy right now, and you could get kicked in the nuts at any moment, and you're just going to be standing there trying to catch your breath. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to, DSAFinancialGroup.com. All my contact information is there. I hope you have a wonderful evening, and I shall talk to you next time. Adios.